Well, it's been a slow, subtle burn in higher rates this week. We started out Monday with rates ticking up to 6.76%, thanks to weak bond performance driven by upbeat economic news, specifically stronger than expected S&P Services PMI data. And on Tuesday, despite overnight bond selling, we saw a midday rally that nudged rates back down to about 6.74%. Wednesday and Thursday brought minimal day-to-day change, but the net movement was still slightly higher, and then finally 6.78% respectively. But on Friday, finally, despite the hotter than expected PCE inflation report, bonds brought a small rally, helping rates settle slightly lower to around 6.76% to close out the week. So yes, we ended the week right about where we started, but not before taking a slow climb towards the highest levels in over a month. So why did the rates move like they did this week? Well, it all started on Monday with what we call risk-on energy. Investors reacting positively to news of expanded tariff exclusions. Stocks rallied, bonds sold off, and that pushed rates higher. Then came Tuesday's consumer confidence numbers, the lowest since July of 2022. That usually sparks concern in bond buying, which is exactly what we saw, leading to a temporary rate dip. Wednesday gave us durable goods orders that were stronger than expected, another reason for markets to pump the brakes on optimism about rate cuts. And then Thursday's job data, the Q4 GDP revisions and jobless claims were mostly as expected. But it wasn't really until we got to Friday that things kind of got interesting. And that's when we saw the PCE inflation report, as mentioned in last week's mortgage update. This is the Fed's preferred inflation gauge, and it came in slightly hotter than forecast, but the bond market barely flinched. And why was that? Well, it's because the numbers were close to expectations, and some traders were likely just relieved that it wasn't worse.